The Share Pickers Weekend Podcast with Justin, Paddy, Peter and Steve. The content of this podcast is not intended as investment advice. It is for information purposes only. People in this podcast may hold positions in the stocks they talk about. Do not buy anything based solely on a tip or recommendation. Please do your own research.
Welcome to the Weekend Podcast with me, Justin. That's it. The boys aren't talking to me because their portfolios are down, they're depressed, they don't want to talk about their portfolios or look at their stocks. Well, there's a little bit of truth in that. In fact, Steve's at the cricket in Wales. I think he's working there. He's the umpire, I believe. And he said he doesn't know much about cricket, but he'll give it a go. I think that's out. Is it out? No? Okay, he's in. Stay in then until you get out. But no, I think Steve's filming there. Paddy is on a sort of road show, I think, doing stuff like the McEnroe film, maybe, because he's working on that, of course, a documentary on McEnroe, which... the legend of tennis. And if you don't know, my wife didn't know who McEnroe was. She said, let's go and see that film McGarry. I said, McGarry? Who's McGarry? But, yeah, if you don't know who McEnroe, it depends on your age, I suppose, but he was a legend of the 80s in tennis, really disruptive player with the attitude of Nick Kyrgios, but the talent way above that. And like I said, it was him at the time. Bjorn Borg was the man to beat. And I think he won 5 or 6 Wimbledons. Very calm Swede. And not the vegetable, of course. And then McEnroe came along. Very brash, loud American, arguing with the umpires. And he won it. He became the best player in the world. So it's a documentary on that. So if you want to get out of the heat somewhere this weekend and check out that film and give it a good review, I think Paddy would be happy. Pete he's been in France for quite a long time. He said he's working very hard. He hasn't looked at his portfolio. That's a good thing. You go back to that stat. It was about one of the big investment houses, one of the biggest in the world, Fidelity, I think it was. And they said that generally dead people outperform active investors. Because active investors jump in, jump out, jump in, jump out. And we know, the bear market's hard. It's been with us now 10 months, pretty much, on AIM. But generally the stats, and these stats go back to 1932, 1929 actually. If you look at all the bear markets with and without recessions, we know sort of how much they last on average. And without recession, they last about 12 months. With the recession, 16 months. So the average all is 14 months. Like I said, we are 10 months in on AIM. The problem is the markets tend to follow the S&P 500, or American markets, a little bit. So we may come out earlier, but not a lot, and that's only 6 months in. And I did do a survey, actually, on Twitter, saying, when do you think this bear market will end? And I give several options between 1 and 3 months, 3 to 6 months, and up to 1 month, sorry. So within 1 month, when do you think the bear market is the bottom of the market? Within a month, 13.3% of people said that. 1 to 3 months, 21.1%, 4 to 6 months, 27.1%, and 38.6%, the majority or the biggest sector was 6 months plus. And I think it could be that. I think it could be 4 to 6 months. We may even have a rally, in the late stages this year. And if you go back to the Great Financial Crash, that lasted 19 months until we see our bottom there. And of course, that was a major sort of recession, the banks are collapsing, all that stuff. So that was quite serious. We have inflation now. I mean, inflation is quite sticky. It won't go down a straight line. It'll go down, maybe plateau, maybe even tick up once or twice, and there'll be worries in the markets coming back. And I did look at the S&P 500 after the Great Financial Crash, and there was 2 rallies there. They were phenomenal, and they weren't the bottoms. They were sort of fake rallies there. There was 2 fake bottoms, 1 real one. The first fake happened on the 28th of October 2008, and it rose by 10.79%. The indices in 1 day, and continue to rise to 1,005. This is from 848. So it did an 18.5% rally. That wasn't the bottom. The second fake rally was on 20th of November. It rallied by 24%. In the next few weeks, and these included days where the S&P went up by 6.5% and 5.2% in 1 day, and indices. But even on that, and this is what happens. You tend to get really aggressive rallies towards the bottom of the market, where they're trying to find the bottom, and then just big sellers come in and takes it down a bit further, or you have big news come out that takes it a bit further. But then off the bottom, The real bottom happened on the 9th of March. The day before was what's called a Star Dojo candle, where basically the bulls and bears fought all day, buying and selling, and there was quite a big range on the day where the S&P went up and down, but it finished right in the middle, so neither won. The next day, the index went down by 1%. Then the next day, it opened at 679, and it rose by sort of 6.5%, and it closed at the high of the day. So a day where it didn't go anywhere, a day where it dropped 1%, and then the next day, a big up day, and literally, it opened and went straight up 6.5%. Lots of buy volume coming in. And then it started, I think it was rallied from the 10th of March to the 10th of June. It rallied by 40%. So, and the thing is, don't go too early. You're never going to guess the bottom on a bear market. And, and I keep saying that it's better to be late and right than early and wrong. It's like going to a party the wrong day. If you turn up to a party, no one's there. Oh, on the wrong day. If you go to a party and you turn up sort of half an hour late, doesn't matter. You're still in the party, So it's worth looking at that. And so just some stats here on the thing. I mean, the best time to make money ever in the stock market is after a bear market has ended. There's like an 84% chance of a positive return over the next 2 years. And look at the AIM All-Share Index. It's down 34% at the moment from its high on the 28th of August 2021 to its low on the 5th of July. And we've had some negative news come out. You've got the American CPI data, which is Consumer Price Index data, come out. And it was worse than expected, but the markets didn't go to new lows, which is quite a bullish sign, really. It's almost like everything's sort of priced in. And of course, we are seeing inflation sort of roll over. You've got lots of commodity prices down. Trouble is, that will take months to feed into the actual consumer price inflation data, because that's consumer price, of course. And by the time it gets to the shops and the shelves, it takes a couple of months. So we may have seen peak inflation, but we just want evidence of it. But so look at the AIM All-Share Index. 314 days now from the high, okay? Down 34%. Now, after the Great Financial Crash, the AIM All-Share rallied by 20% in the first 50 days, 43% in the first 100 days, 70% in the first 200 days, and by the time we got to a year, it was like close to 85, 90% up. That's how fast the market can turn. And we know the stats on this. Like I said, generally, every 4 or 5 years, there's a bear market that lasts for 12 to 16 months on average. And then you get, 3 to 5 years of rallies, and it is worth, if you've got a high conviction stock, I believe, try and find some cash from somewhere. There will be rallies. Honestly, there will be rallies in some of the stocks. If you can get some cash, because the ideal thing to do is try and get your average down. You're never going to, guess the bottom of the market. But if you can get a good average, and that's the point. If you can get a good average down to where you are, so if you're like 50% down the stock, try and get it down. Try and if you're sure the company you're investing in is a good company, it's growing, it's going to be profitable, it's in a hot sector. If you're guaranteed of that, then it's good to try and get your average down in that stock. But don't overexpose too much. And don't go too early. Like I say, you can wait. Doesn't matter. And I do say this: the best time to make money is after a bear market. The trouble is, many go too early. 15 years ago today, in fact, Thursday this was. 15 years ago on Thursday was the high before the Great Financial Crash. Of course, no one knows where the high is or the low is, but we do know in hindsight. And now, if you put 10k into the All-Share AIM Index after it had risen by 20%, i.e., the start of a bull market, that's the definition. So we know a bear market is 20% from recent high drop, and a bull market is 20% up from a recent low. Then that 10k, if you put it into the AIM All-Share Index after it rallied 20%, start of a bull market, that would now be worth £19,283, even after this drop of 34%. You'd have made a 92% gain, so in the last, 12 years. So, timing's not everything, but it's very important. And like I said, it's best to wait, keep your powder dry. We know, pretty much, it's going to be around for a few months. So it's plenty of time to look, research, learn about stocks, or just to have some, keep your powder dry, as I say. Keep it there. don't plough it in yet. I mean, the best thing to do, if you've got a long-term outlook, of course, investing and your horizons are, say, 3 to 5 years, you're fine, but don't rush in now, because there will be rallies and there'll be dips along the way where you can pick up. And I think what you need to do is essentially get confirmation. If you're investing in a company at an early stage and it's doing well, but you're not sure of future updates, whether they'll be affected by the slowdown in the economy or inflation, then wait. Because in this market, what tends to happen is if a company releases news that exceeds expectations, it will rise, but that will provide a liquidity event for people that are underwater on the stock pretty much, or worrying about the economy, to sell into it. So those rises don't last, they're not sustained. You've got companies then that release news that's in line, again, creates a liquidity event, gets sold into, and they go down further. Now, if a company releases news and it's below expectations, take a hammering, to 20 to 50% in this market. That's where it is. That'll stop happening in a while. You will notice a turn. And I said, it doesn't matter if you're a bit late, but it does matter if it can help you if you get your average down in a good stock. And by doing that, I mean, scaling in on maybe on a monthly basis over time. Don't overexpose, depending on what your risk tolerance is. How you tolerate volatility. Don't overexpose, but it's the best time, honestly. Next 3 to 5 years after the bear market's ended, the markets will rally. It's almost like a tsunami. Money starts coming in, more money starts coming in, which drives more people to invest. Share prices go up. People put more money in. It's self-fueling. It's like exactly the opposite of the bear market. So we will see, an excellent rise in the stock market over the next few years. From where we are now, or even a bit lower. I mean, I do think it'll go a bit lower. I think it will rally a little bit, maybe test a bit lower. But I do think the greatest pain has been felt. The biggest drop has been felt. I mean, even if you go back to the Great Financial Crash, that was down 49%, aim at all share. And that was serious, almost global financial infrastructure was imploding. And that went down 49%. We're now on high inflation, 40-year highs, it's coming down by the looks of it. But we're already down 34%. So, I don't think there's a lot more pain to be had, but I think there's a lot more gain to be had. All right. Just quickly on a couple of stocks I own. E-Energy's got hopefully a trading update out next week. And I did 2 videos on this and a short video on it. And the reason why I like this company is because, and I don't think people understand this. I mean, in a bear market, nothing really works very well. I know that. But it's largely not only insulated from the issues of today, but they provide excellent tailwinds for the company. I mean, if you don't know what E-Energy does, it gets companies to cheaper energy bills in a clean way, so decarbonises and gets your bills down. And they've had, if you go on YouTube and just search up their account there's testimonials and case studies of clients they've worked with where they've brought their bill down by half. Literally, you talk about school trusts where their energy bills gone up from 1 million to 2 million, and they've brought it down. And not only that, what's very important for companies at the moment is there's no upfront costs. So companies will not provide any cash flow upfront for this. It's as a service. And this is why I do like E-Energy, because essentially, in this environment, the most important thing for most companies, or the biggest cost they have, which has been increasing, is energy. So we're in an environment that plays into E-Energy's space here. It's very good for them, this environment. But they're also obviously getting companies to net zero profitably. So there's 2 massive trends there playing into each other. Energy prices will be high for quite a while, but they'll help people get it down. But also, it's there's 2 ways E-Energy earns revenue: by consulting as a service to companies, long contracts, recurring, and again, that's very good in this environment. You want guaranteed revenue and income. You don't want the company you invest in to be affected by the squeeze on people spending, consumer spending squeeze, inflation. You don't want that. You want companies that are insulated from that. So I like that, and because we're in an uncertain economy here going forward. So you want almost certain guaranteed revenues coming in. And E-Energy's contracts are recurring. They last about, on average, 6 years. So they're long and recurring, so guaranteed revenue, and they're growing very well. So that's why I like that. And of course, net zero as well, massive targets every company has in the world. All the big emitters have net zero targets, and they also do that as well, get you to clean energy very quickly. But they've got a trading update, hopefully, coming out this week. Now, they've guided already. They say they expect revenue to be 23 million, EBITDA of 3 million. They are a 26 million market cap, all right? And in their previous trading update, we know they've got a record forward order book, which has increased from 18 million on the 31st December 2021 to 23 million in March 31st. So in a few months, 3 months, that order book has gone up by 5 million there. They've done record contract signings in Q3 of 8.6 million. Q3 is that there's the end of years in June. So we're now at 2023 for them. But Q3 will be from January to March. 8.6 million there. Momentum, they say, is continuing into the start of Q4, and this update was in Q4, so obviously can't give full guidance on that. They've also got new parts of the business, which is e-solar and EV charging. They say during Q3 and Q4 to date, heads of terms have been signed for 7.8 million of contractual value there. And just looking at the growth there, very important, if we are going to a lower growth environment, you need to find companies that not only have growth, but are insulated from the wider uncertainties. And that's why I like energy. They're pretty much, this environment is good for them, you know. And by the way, they get their money on volume, not the cost of bills. So if a company, for example, signs up with them and they reduce their energy use, and then energy prices go down, and people tend to use a bit more because the bills go down, so that won't affect them at all. But anyway, revenue. If you look at the growth, previous growth, 2020, 4.5 million, 2021, 13.6 million, that's 200% gain. And like they're guiding to 23 million this year, so another 70% gain there, of course. Now, on the EBITDA, earnings before interest, tax, depreciation, amortization, they did 830k in 2021. In 2022, they expect to do 3 million, so that's 250% gain. And now started this year, 2023, 5 million, so it's a 66% rise there, okay? Like I said, forecast for 2023, which we're now in, it started on the 1st of July, their year. Revenue for 30.5 million, EBITDA of 5 million. Looking at the valuation, their EV sales right now, multiple is 1. EV EBITDA is 8. In 2023, this will drop. Of course, we stay around the same price to 0.8 for EV sales. EV EBITDA will be 5. It's very cheap. These kind of companies, easy sort of 15 times. And it's just going back in March 2021, when we're in this, in a decent bull market, this company was valued at 66 million, and that was on sales of 13.6 million for the year, which, that was 5 times sales. So currently they're valued at 26 million with sales of 23 million. So like I said, in 2021, their EV sales was 5 times. In 2022, that's 1. And they're a bigger company with more parts of it, 4 different businesses now, fully integrated. And I do think we'll go back to the time when they will be valued at 3 to 5 times sales. So I think you're looking now on, say, 2023 figures. If you're looking at 13 million, that's 150 million market cap, and we're now at 26 million. So that's that 5 times in money there. So 5 reasons I like them. Hot sector. It couldn't get hotter than this. Energy bills going up. Net zero. Huge targets for the company. Recurring revenues. Like I say, in an uncertain environment, you need certainty. And that's why they have these recurring revenues will come in. They also have long-term contracts. And, of course, they are being hitting record contracts going forward. They've got strong growth, and the valuation is very good. So hopefully we'll be seeing an update from those in the week. That's it for the podcast. I hope you enjoyed it, and I hope I didn't sound too lonely. Thanks very much. Speak to you next weeky.
The Share Pickers Weekend Podcast with Justin, Paddy, Peter and Steve. The content of this podcast is not intended as investment advice. It is for information purposes only. People in this podcast may hold positions in the stocks they talk about. Do not buy anything based solely on a tip or recommendation. Please do your own research.